Today we're going to be looking at HanesBrands with ticker symbol HBI. The reason for this is based on screening some basic financial metrics. HanesBrands is looking like an interesting investment option right now. They just missed on earnings and lowered forecasts, and the stock went down over 16% on Friday. Annual sales and earnings actually grew but did not meet expectations. Sales were $1.58 billion, while earnings per share came in at $0.41. Hanes also spent more money than it earned from operations in the prior 4 quarters. The main reason for this, of course, was the completion of the Pacific Brands acquisition for about $800 million in 2016. They're expecting Pacific Brands to contribute about $70 million in adjusted operating profit annually. Some data we're looking at here is showing that the company is actually number 1 or number 2 in terms of market share in their key categories, as you can see in these tables here. So for example, in men's underwear in France, number 1, and so on, and looking just internationally, Canada number 2, Mexico number 1, and they have a strong portfolio of brands, which was of course enhanced by the Pacific Brands acquisition that was recently completed. Next, I want to look at some financial metrics, which is why why Hanes came to attention in the first place. For one, the stock has performed quite poorly lately. As you can see here on the 52-week range numbers, we are at the bottom of the 52-week range now, with the share price 18.91. The high for the past 52 weeks is 30.58. Comparing some of the financial metrics to the industry averages, the price to earnings multiple for Hanes is 13.5, while the industry is more in line with the market in general at over 26. The return on equity number for Hanes is 42.3, while the industry average is actually a little higher, or significantly higher, 53.09. They do pay a dividend. Their current yield is 3.2%. Their profit margin is 8.9. They're also looking slightly cheaper than the industry when you look at price to sales, 1.19 versus the industry average 3.63, and price to cash flow 11.21 versus 17.21 for the industry. So next we'll look at another way to value Hanes. What the numbers we're using here are the current quote 18.98, the PE ratio 13.5, the earnings per share 1.41. The estimated long-term growth rate for Hanes is 10.13. This is just based on an average for the analysts covering Hanes. And just a note here, the PE range for the last 5 years was 13.5 to a high of 27.89. So we calculate future earnings per share by taking their EPS, multiplying it by 1 times the expected growth rate, raised to a power of 10, since we're looking over a 10-year time period. Then we calculate the future stock price, which is the future price times the expected future PE. A PE of 20 was used, which you see is somewhere in between the current PE and the high for the last 5 years. Using that future stock price, we're able to see what the present value should be if we want to earn 10% over the next 10 years annually. We want to earn 10% annually for the next 10 years. Then you get a present value of 28.53, which of course is significantly higher than the current price of about $19. If you were okay with earning 5% annually, you would get of course, a much higher present value of 45.43. So you can play with the numbers here if you want to adjust the estimated long-term growth rate and see how favorable it looks depending on what your estimates are there. Some risks for Hanes include the integration of the acquired businesses. So this is considering things like consolidating certain areas, eliminating duplicate positions, and standardizing business practices. They have to achieve certain cost savings to justify the price they paid, of course. Additionally, a risk for any consumer products company are the regulatory, political, and economic risks. However, in the case of Hanes, the majority of their products are replenishment in nature, so they're not really impulse purchases. Consumers buy them more on a planned or regular basis rather than based on impulse or trends, I guess. And another risk I left off here, but is just that it's a very competitive industry, so they do have a lot of competitors both online and in the brick and mortar stores. Next, we're looking at the 1 year performance, of course, is pretty bad. They've actually gone down about 38% in the last 12 months, which is, of course, why they're looking at an attractive price now. If we look at the 5-year performance here, we see they have actually significantly outperformed the S&P 500, which is the green line here. So again, it's based on the time frames you look at, you'll see a much different picture. Finally, another risk or general market thing to consider is the current PE ratio is, like I mentioned in my last post, of course, it's still very high. We're at 25.79. The median is around 15, so we're definitely at levels we've only been to a couple times before. So it's just an expensive market, so keep that in mind. So that sums it up for this edition. Remember to check the link included in the description below for more information and to see the next post. Thanks. Bye.